Hey guys, it's Craig from Wattle Accountants. Today we're going to talk about how to claim your stock as a tax deduction. So firstly, your purchases you would think are a tax deduction, and they are, but you can only claim them when you've sold the goods. So you need to work out what the cost of the goods that were sold in that financial year. So it may seem tricky at first, but if you work through the formula, you can actually work out which goods were sold and what the cost was. So it's easy to explain in a worked example, which we'll do now. So on the spreadsheet, we've got the 23 financial year here. We've got three different numbers we need to find out, and that's going to tell us what our cost of goods sold is. So opening stock, let's pretend this is a new business. There's no opening stock, so pretty straightforward. The purchases, so this is all the goods we've bought through the year. Let's use the scenario of maybe a tire shop. So let's say, for example, we bought $12,000 worth of tires in the year. So if you're a retailer, you should be on accruals basis, which means it's not only what you've bought as in paid for in the year, it's also the invoices outstanding at 30 June, which you haven't paid yet. So that will be your purchases figure. So simply, this is not your cost of goods sold, because we need to work out what hasn't been sold, and that's done by putting in our closing stock. So if we go to the Income Tax Act 1997, we've got here 7045. It just talks about how you calculate that figure. So you have three different options. You've got cost, market selling value, and replacement value. So cost is pretty straightforward. If you have a accounting system that has inventory management built in, you're going to know exactly what goods were sold and what the cost was. So that is an option that you can choose. Market selling price is pretty straightforward. So whatever you sell it for, that's the price. And the final option is the replacement value. So if you were to rebuy it from your supplier, that would be the price. So the first step in doing this stock calculation is going around and doing a physical stock take at 30 June. So you'll go around, with a piece of paper, and then you'll have all your different products, and you'll go, I've got one of those, two of those, three of those. These are all the different tires we have, and this is the quantity we have. That's the first step. So you want to do that pretty much on 30 June if you can. Then we're going to times that by either cost, market selling value, or the replacement value. So as I said, if you don't have an inventory management system, you're probably not going to know what the cost is. The market selling value probably is the easiest and most straightforward because you know what you sell it for. And replacement value, you could go look that up, see what it costs to rebuy those, and use that value. So let's go back to our example, and we'll just say market selling. Let's say we've got only 10 tires left, and we sell them at $200 each. So the market selling value, you can see that that's our closing stock. Now, it's now saying our cost of goods sold is $10,000 because we bought 12 and we got 2 left. So we've sold $10,000. So that's how much of the purchases we sold. This is a tax deduction. That's pretty much the end of the story. The next question that usually comes up, is there an opportunity to change this? Which is the best method for, tax purpose, that sort of thing? So cost is always going to give you the lowest taxable income in that financial year. Market selling value is going to be the highest, so it's not going to be as favorable. Replacement value will be sort of in the middle. And the reality, it doesn't really matter what you choose because the closing stock becomes the opening stock for the following year. So as you can see, it doesn't really matter because this closing stock, it really is just an estimate, and it's going to get washed out eventually, whether the business grows or sort of ends. It only will affect your taxable income in that year. It is one tax planning strategy, especially if the income is estimated to be lower in the following year or something like that. You can choose to use the other method that's going to sort of make your taxable income over multiple years smoother or lower overall. However, the actual amount doesn't really matter at the end of the day because it is adjusted in the following year anyway. So hopefully this video was helpful for you, and if you've got any questions, feel free to leave them in the comments below. And thanks for watching the video, and we'll see you at the next one.